Can a short strangle repair a stock that is down in price? Let's take a quick look at different ways to repair a down stock position. This comes from Gustavo. In March, I bought 300 shares of JMIA, cost basis around $30 per share. Stock is currently at $19. I know I could keep selling calls, but I'm planning on selling a January 25 call and a January 20 put for around $5. I'll limit the obligation risk of the naked put or cash secured put by buying a 15 put out in March, creating a diagonal put spread. My new break even is around 27.35. And he then mentioned some other profit and loss points from his broker's chart, which I don't necessarily agree with based on what I saw in power options. Let's take a look. Where is JMI now? Well, it's currently around 19.20, 19.15. So we've got a loss of about 10.85 on the stock, about 36% down. And of course, the break even on just the stock position is $30. Just doing the short strangle by itself with around the $5 credit that Gustavo mentioned. Well, with 300 shares, we'd sell 3 contracts of the call and the put, so we'd take in about $1,500 total. The current actual market price was about $4.67, which comes out to about $1,400 taken in. The structure that I saw in power options with just the short strangle would lower the cost basis from $9,000 for 300 shares at 30 down to $7,500. But this would require the monetary amount in this case of $6,000 for the 3 puts at the 20 strike. So our total requirement and risk now, if the stock went to zero, is $13,500. But as we can see on the profit and loss chart, there's no gain for the next 100 days to expiration in January with those prices. We're essentially break even, zero max profit, 0% return, but not a loss, and of course the break even drops to $25. Now the March 15 put, if I just sold the January 20 put and then bought that March or that May 15 strike put, this would create a calendar spread. Of course, this would remove the requirement of the $6,000 for the 3 contracts of the 20 strike put that were sold in January. But it would also increase the money in the trade. We'd have to put up margin to cover the difference because that 15 strike put does not cover the zone between our obligation to buy shares of stock at 20, if the stock's trading below that, to the 15 strike. It would look like a bull put credit spread in a sense, where we'd have to put up the 5 points of margin times the 3 contracts for an additional $1,500. This would be the diagonal spread by itself. Now, when we put it all together, we have 300 shares of JMIA at $30 per share. We're going to sell 3 contracts of the 25 call, current market price around $1.24, and we're going to sell 3 contracts of the January 20 put, market price right now at $3.43, and it's already slightly in the money. Then we buy 3 contracts of that May 15 strike put for around $2.05. A stock, short strangle, an additional long put, or we could call it a stock converted to a covered call with a diagonal put spread, a bullish diagonal put spread in place. But the profit and loss analysis that I have on this one does not get us back to break even. The maximum return is still a loss of $590 if the stock is above 25. There is no break even because it's all still negative. Now that's only a 6% loss as opposed to a 36% loss. We do have to put up the extra $1,500 monetary requirement between the May 15 put and the January 20 put for that diagonal put spread, which is slightly bullish in position. So the total cost into the position now goes up to $9,700, and that's the max risk if, again, the stock goes to zero. It's not profitable. So what is the play? Well, the potential outcomes, the stock continues to decline. We're still going to realize more losses on the position, even though we took in the $5 of net credit minus the 205. So we did lower the cost basis, potentially lowered the price there, but we're not getting to a profit. If the stock stays between 20 and 25 for 100 days out to January, what happens? The call and put expire. We've still got that long put out to May or out to March, depending on the cost you wanted to use. And we could reset the strangle, maybe selling the 25 and the 25 call, and the 20 put for March expiration or May expiration to get more credit to lower the return down. Now we're out about 220, 215 days out in time. Third outcome, the stock moves up above $25 in the next 100 days. Well, would we roll the short call up at that price and look for further upside? Would we reset the strangle again with different prices? I'm not really clear on what the approach is going forward for Gustavo's position if this is the repair that he plans. Now, are there other ways one could manage a down stock? Well, he even mentioned that he could continue to sell calls. Right now, the position is down about $10.85, about 36%. The at-the-money 1 month out premium to sell just a call against it and continue to do that for the standard November expiration is $1.60. Selling just the at-the-money call about 60 days, 59 days out in time and getting $1.60 would take 7 months, roughly 210 days, to get back to break even. And if the stock has a large jump in price, we run the risk of getting assigned for a locked-in loss. In this case, just the first cycle, selling the November 20 call at 160, we see that we would have a max profit of a loss of $2,520 or 29.6%. I guess it's better than 36%, but do we want to stay in this position for 210 days, 7 months or so, to get back the 1085 we're missing, assuming that we can just keep getting the 160? Yes, the cost basis might still lower. Yes, the stock might move back up. We might get more gain on the stock. But again, just assuming $1.60 every 59, 60 days or so would take us 7 months. What about a tighter strangle? Instead of going out to the 25 call and using the 20 put, what if we just used 2 out of the monies but sold, let's say, the 22 call, just a few points out of the money, and an 18 put? This would maximize the at-the-money bell curve. We're going to get slightly more premium, and if we're able to go month by month by month, we might be generating about $215 every month. It would take 5 months to get to break even for the 1085 or down. Now, of course, this also comes with the other problem. We sell 3 out of the money calls at the 22 strike for November expiration, 28 days out or so, and make 97 cents or so on that position. It's just a covered call. But then we sell 3 of the 18 puts, and that would be a monetary requirement of $5,500 to be cash secured. Now, the total cost in the position are $9,000 into the stock, minus the premiums we receive, plus the monetary requirement to cover the put, goes up to $13,750 roughly. Again, that's the maximum risk if the stock goes to zero. But if the stock falls to 18, 17, and 16, we're going to be losing more money because we're losing on the sold put now and the stock position as well. If we get assigned at 22, at November expiration, November 12th, the stock goes up above 22, 3 points away, and we get assigned, the loss is only $17.50 now roughly, or minus 12.7%. Much better than 36, but again, we're not getting back to break even. Let's table that and take a look. We know our stock's down 1085, trading at about 1920. We have a cost basis of 30. Doing the monthly at-the-money covered call will give us a max return of a loss, $2,520 in the first cycle, or minus 29.6%. A little bit better than the loss of liquidating right now. It does not get us back to break even. Assuming that we can get $1.60 every time to get back that 1085 we need, it's going to take about 7 months to get back to break even. Of course, that could be helped if the stock does move up. We don't have to get as much because we're not losing as much from 30 to 1920. There's no extra cost or requirement for doing this, and the new total risk or the total cost in the position drops from that $9,000 down to $8,520 for 300 shares. The straightforward monthly strangle position. If we were just assigned on the short call, just using the 25 call and the 20 put that Gustavo mentioned, this would be a maximum profit of a loss of $1,749 or minus 12.7%. We do not get back to break even. Assuming we continued this strangle and got that same premium we were looking at, it would take about 5 months to get back to break even. It would add a $5,400 requirement for the 3 puts that were sold. And again, because of that, now the total cost and risk goes up to $13,750 per 300 shares. The 100-day out strangle. If we just took Gustavo's January 25 call and the January 20 put, we saw that we got to break even. 0 return was the best expectation in 100 days, and the break even was at $25. Takes a little bit more than 3 months to get back to break even. In this case, we didn't use the put option out to March or to May that he mentioned, so we would have to put up an additional $6,000 to cover the monetary requirement of those 320 strike puts that were sold. Now, again, the cost basis, total risk goes up to $13,500 per 300 shares if the stock goes to 0. The key here is we could be losing in these monthly strangle or the 100-day out strangle. If the stock continues to decline, we're losing on the stock and we're losing on the sold put premium that we put up capital to cover as a cash secured put. Now, the proposed adjustment, the covered call with a diagonal put or the short strangle with the extra put, we saw that the max return was only a loss of $590 or 6.1% at January expiration, 100 days away. We did not get back to break even. Now, the idea was if we did this and the stock stayed between 25 and 20, then maybe we'd re-bracket the strangle out to May or out to March, depending on which put he bought, to get another $4 or $5 in premium. So at May expiration, that's 220 days away. That's going to take about 8 months to get back to break even with this approach. We do have to put up an additional $1,500 in this case to cover the difference in the strike prices from buying the May or March 15 put and selling the January 20. We'd have to cover that difference. So the risk is $9,717 per 300 shares. This is a comparison of extra risk versus the break even. Again, the 100-day out short strangle, additional cost of $6,000 only to get back to break even. It's the only one in that table that got us to break even. The proposed repair only added $1,500, but did not get to break even. Now, if we're willing to add $1,500, or we're willing to add $6,000 for the short strangle 100 days out to get to break even, what if we took $1,920 into the position? We had a little cost basis, $1,900. We'd have to put up the $1,500 for the trade that Gustavo proposed. Let's add $420 to that. Why? Let's buy 100 extra shares of JMIA at $19.20. Current cost per 300 shares is $30 or $9,000. Our new total cost in the position goes up to $10,920 or $27.30 per 400 shares. It's a means of averaging down. Why am I doing this? Well, I might consider doing this because now I could use the stock repair tool. The stock repair tool builds us a ratio call spread to help us get back to break even faster. You may need level 2 or level 3 approval for your trading. We're assuming Gustavo has that already because he was considering the diagonal put spread. It's a very simple tool. You just put in your stock, your cost per share, and the total number of shares. Here we're putting in our values of 2730 and 400 shares if we add that extra 100 shares for $19.20 or $1,920. You can access the stock repair on the top line on Power Options. Just put in your symbol and click on Stock Repair, or through the Signature Tools tab on the main menu bar. No credit or debit repairs exist for the current position, 300 shares at $30 cost basis. But by slightly averaging down, adding that extra $1,920, we still don't see any credit repairs, but debit repairs appear as early as October, with new break-evens of around 23.54, 23.65, and we also see repairs out to November and out to December as well, with different strikes in the combination. What is the trade entry for this repair? Well, if I click on the repair details, I see that the repair for the 29th of October, remember now I have 400 shares of JMI at a cost basis of $27.30. We'd buy 4 contracts, the 29th of October, 19 call for $1.10. Now I'm adding more debit into the position, $440. I don't get a lot of premium, but we could sell 8 29th of October 24 calls, twice as many as we're buying, for 5 cents. It brings in roughly $40. So now I have a net debit of $1 per contract, or net debit of $400 total. This gives me a break even of $23.65. How am I getting from $27.30 new cost basis on 400 shares to a break even of $23.65 by adding an additional $400 into the trade? What do we have here? Do we have a ratio spread with half of the positions of a naked call? No. Your broker would see it as a covered call, where half of the calls that you sold are covered by the now 400 shares of stock. The remaining 4 short calls are covered by the 4 long calls you bought. So it's just a covered call with a bull call debit spread. And what happens if the stock's trading at $23.65? Well, as the stock starts to move up, we're accelerating our gain on this profit and loss chart. We're gaining on the long call and gaining back on the stock. And we reduce the cost of the long call by selling those further out of the money 8 contracts, twice as many as we bought. So $23.65, our loss on the stock is $3.65. With the new $27.30 cost basis, we have $4.65 of intrinsic value on the long calls. Sell to close those. The 28 calls expire worthless. We did pay a debit of $1, so it wipes out. Now, if the stock did go up to 24 at October expiration, that bull call debit spread, the 4 strikes of the 19 call and the 4 extra calls sold at 24, would have the full profit of 5 points. We could deliver the stock at 24 based on the 4 contracts we sold against our 400 shares, close out the bull call debit spread for full profit, and now with the stock just trading at $24, we've got a max profit of $280 or 2.5% if we're assigned on October expiration with the stock trading at $24. Let's look at that table again. We already know what happened with the monthly covered call taking 7 months. Just doing the monthly strangle, using that tighter strangle to maximize the ATM bell curve, selling the 22 put and buying the 18 put, I would take 5 months to get back to break even, would increase the cost basis to $13,750. Gustavo's 100-day out strangle by itself got us to break even, but had the largest addition of extra requirement to cover the 320 strike puts that were sold. The proposed position that Gustavo mentioned might only take a loss of 6.1% if the stock's above 25 at January expiration, but then it would have to be adjusted. It might take as long as 220 days to get back to break even. Small additional cost of $1,500. What about averaging down with the stock repair? Now we have our max return of 2.5% with a break even at $23.65. The time to break even, if everything worked out, is only 14 days away to October 29th expiration. We did add extra cost. We added the $1,920 to buy an extra 100 shares to average down, and that new debit of roughly $1 or $400 total. So the increased cost, increased risk went up to $11,320 per 400 shares. What do all these repairs have in common? They need the stock to go up. We would have to have a very bullish outlook on this position. Further losses can be realized to the downside. Now, what are we talking about here, even with the stock repair with a break even at $23.65? That's still a 23% gain from where we are now. We need about $4.45 to get up to $23.65 from the current price around $19.20. That's a very high expectation for 14 days. If I needed more time, We could evaluate that November stock repair, which was 35 days out, almost a similar price, or the December, which was 63 days out in time, and was still around $23.50, $24 of a break even in that case. But again, it's a very large expectation to have for a shorter term to get back to break even. Disclaimer, this is just another idea of how to repair a stock. As with all types of repairs in this position, it does require the stock to move up pretty significantly in a shorter time frame. It does not limit further losses to the downside. I don't have any extra obligation other than cost for that extra 100 shares by averaging down and doing the stock repair, plus that little debit there. But if the stock falls, we haven't hedged any loss to the downside. We could still realize larger losses. The stock is down 36%, around $10.80 or so. And we have earnings coming up around November 9th. That's currently unconfirmed. They haven't released the exact date. But this is a concern because all of these repairs require the stock to go up. And the only one we saw that would get us to a profit is the stock repair position, with the stock only needing to go up to 24 for a max profit or 23.65 to break even. We did see break even with a short strangle, but that was an extra $6,000 because the extra put wasn't covered. Now remember the general rules. It's not necessarily a good idea to continue rolling down covered calls for the sake of rolling. You want to make sure that the stock still matches your sentiment. If the stock has fallen, you want to take a look at it. Why did it fall? What is the reason behind falls? The rest of the market going up while my stock is going down. I might want to consider getting into a new position with a lower loss in that case, taking a lower loss in that case, and find a stock that better suits my goals for the strategy or the sentiment that I'm using. We don't always have to repair the exact losing trade. Now we're down 36%. Okay, we saw some ways to repair the position. But as the stock started to move down, we have to analyze, why is it not going the direction we want for whatever strategy we are in? And of course, can I make it back on other trades that are moving in the direction that I want, rather than letting the losses pile up too much? For stock positions, covered calls, sold puts, or most other neutral bullish strategies, consider exiting those positions if the underlying security has fallen 7 to 8% from when you first got into the position. Yeah, we know we can make 2.5%, 3%, and if it's only down 7%, that's just going to take me 2 months to get back to break even. But as it continues down and continues down and continues down, now it's much harder to get back to that break even. We're extending our repair time out 5, 6, 7, 8 months. It's better sometimes to just take the lower loss if possible. Don't try to repair the same trade if it's not going in the direction that you want in those positions. Don't keep rolling down, hoping to recover in those cases. Try to keep losses to single digits. Now, I might have taken in a 2 or 3% premium on the initial, let's say, 300 shares of JMI when I sold a call against it. And so the stock falls 9%, I get out with a 6% loss. I decided to myself, it's time to get out of this position. It's hit my trigger. I don't like what it's doing. Let me back out of this one. Let me find a different stock that's doing more what I want to match the strategy that I'm using. And it's easier to recover those positions over time. And again, I just want to state forth this disclaimer one more time. This is just another idea from a repair. This is not a direct recommendation for Gustavo on his position, but it's something that you might want to consider and evaluate. Options involve risk, may not be suitable for all investors. They do give us great ways to hedge positions, maybe repair positions, but we have to make sure that any repair that we do matches our sentiment for the stock going forward.